Hi, I'm Ben Reppond. Today is November 9th, 2022. Welcome to my YouTube broadcast. You know from last week, perhaps if you watched it, that I have separated the economic information from the stock market information. So this video will be focused on the stock market and the bond market, data, dashboard. Hopefully you watch it and you'll know exactly what's been going on. The data is through last Friday, so it's not up to the minute, but it's fairly recent, and I think is designed to give you a snapshot and a view of what's happening. Let's start with the dashboards, a couple of dashboards. One, this shows the indexes, and there's a general direction. I think you'll see by the time we finish, there's a general thing that's going on with the market. Last week, when you look at all of the major indexes relative to their 20, 50, 100, and 200-day moving averages, that's what the last four columns of dots are on the right, that there were 12 green dots, meaning they were above each of those moving averages. Different ones had, green dots, but a total of 12. This week there are 9. So what that tells me is that the market in general, and this includes both the equities as well as the 20-year government long-term bond, and the U.S., developed markets and emerging markets. So really broad snapshot of what's going on in all of the markets. The two of them, the NASDAQ 100 and the 20-year long-term government bond, are below all 4 moving averages. But then when you get to the Dow, the Russell 2000, the S&P 500, developed markets and emerging markets, some of them are above, 1, 2, or 3 of the moving averages. There are a set of numbers, data, percentages that go across from left to right after each one of those averages. Starting with the percentage change on Friday for that day, next for the week, for the month, for the quarter, and for the year. I kind of focus on the year, and the Dow is down about 10% for the year. S&P is down about 20, and the developed markets down 22, emerging markets down 25, NASDAQ 100 down 33%, and the long-term government bond, the one that was supposed to save you from equity risk to go up when equities went down, is down 36% year to date. When we take the S&P 500 and break it apart to its component parts, there are 11 sectors, different segments of the economy called sectors. And just like in the last slide, this shows the percentage change for the week, the month, the quarter, and the year. And then a red dot or green dot, is it above or below its moving average? And you can see that there are 23 green dots out of 44, about half. Last week there were 29. So what that shows is some slippage and it was a slight down week in general, but this chart and the previous chart both show the same thing. So you can see the top one is energy, which has by far been the winner this year, is up 64%. 64. And then everything else is negative, going all the way down to the bottom where there's technology, retail, consumer discretionary, and telecommunications, all down 30 to 32%. Now I want to show you some charts. This is a one-year chart. It's a weekly chart, meaning one move equals 1 week of data for the past year. And this is SPY, SPY, which is the exchange-traded fund for the S&P 500 index. And you can see that during this past year, in general, the direction of the S&P 500, which I'll call the market, is down. There are short periods of time where it tried to go back up, but the sentiment was so negative that sellers came into the market or those shorting the market came in and pushed it down. You can see what I was talking about in the previous two slides. You can see at the very end, the lower right of the chart, you can see that downtick, and that represents the week. So the week was a down week, not a big down week, but it was definitely a down week. And the black line cutting through the middle of the data shows that the general direction is still down. The S&P 500 has both growth stocks in it and value stocks. Growth are companies that primarily focus on revenue. Value are companies that primarily focus on earnings or profitability. And this chart is a ratio. It's a ratio of growth numerator divided by value denominator. And so if it goes down, that favors value. If it goes up, that favors growth. And you can see there's some efforts for it to go back up, meaning growth came into prominence. It was more, it was stronger than value a little bit, but most of it, a lot of it is down, which means value, value, value. Companies that are focused, old economy stocks that are focused primarily on earnings. And even last week, the last couple of weeks, look at the very far right of the chart. Growth is just still falling out of bed, so to speak. Okay, the next chart is a ratio. This is the small cap divided by the large cap. The small cap is represented by the Russell 2000 ETF, IWM, and the large cap is represented by SPY, SPY, the large cap, the S&P 500, the largest 500 companies on the stock market. And so it's a good indication of, are stocks going, large companies tending to outperform small companies. When it goes down, that favors large companies. When it goes up, that favors small companies. If the market in general, and it was during the last year or so, was going down, these indexes went down. So it's not a question of one going up so much as it is which one went down the least. And so for most of this chart, you can see the kind of the center part of the chart, you can see where the S&P 500 lost less than the Russell 2000 small cap index. So both of them lost money. S&P lost less than the Russell. However, when you get toward the right part of the chart, that's why I put an arrow in there, you can see that the Russell 2000 small cap index is starting to go back up and slightly, not a lot, slightly outperform the S&P. They may both be going down, but the Russell 2000 small cap index is starting to go down less than the S&P 500. On the far left of the chart, isn't it interesting, when small cap was in favor over large cap, look how far that went up. I mean, that was small cap, when it is in favor, it is really in favor. And then, of course, conversely, when it turned around, when it went out of favor, it really went out of favor. Okay, now I'm going to switch to an absolute chart. This is the TLT, which is the long-term government bond, 20-year government bond. And you can see, compared to nothing, just itself, you can see there are two periods of time. And this is a 30-month chart. So you can see that the first part I marked with the first black arrow on the left, the bonds, the long-term government bond, dropped a lot during that period of time. It made an attempt to go back up, and then it collapsed. It did not hold the value that it had, and it is still, even the last tick down representing the last week, it is still on its way down. So who knows where the bottom is, but it is not yet at the bottom. So we will find out whenever that happens. But this, the reason this is significant is this and the following two charts I'm going to show you for the intermediate term and short term. bonds are a very big part of portfolios. So these are ETFs. They represent that as a surrogate for a portion of what's in traditional portfolios designed by traditional financial advisors. And that's why portfolios have collapsed so much, is because not so much just because of equities, but because bonds did nothing to counter them. And I mean, you could see this coming. I could see it coming. If I couldn't see it, I know others can see it. So it's curious that no matter what, the traditional financial advisors are holding to their traditional model, is that no, bonds have got to be part of portfolios. And I haven't heard of one of them that has gotten out of bonds. Maybe some have, but I've not. Everyone that's reporting to me are reporting that financial advisors are telling them, no, you stick with bonds. You know why? Not because bonds are wonderful, but because they don't have an answer. They don't have an antidote for equity risk, other than what they've been told for the last 40 years, is that bonds tend to counter stocks, which they have for the last 40 years, until we got to 2022. And now we're in a different game. Now we take a look, same thing. This is the intermediate term bond, the 7 to 10 year bond. IEF is a symbol, and you can see again it moves slightly differently, but generally about the same, both of those same time periods over the past 30 months. And then the short-term government bond represented the 2-year bond. I'd say, I think it's 2 to 5 year bond. It primarily has lost its value, a lot of its value in the last, last year. And just going down and down and down. And as I showed you earlier in that chart, that the general direction is down, and when the short-term bond is compared to the intermediate term or long-term bond, it actually is outperforming them. And from a standpoint of yield, which means the decline is greater. And that's why that is such a pronounced downward slope relative to the opportunity to make money. Gold, this is a 48-month chart. The long-term direction of gold is down. It had a positive week last week, but it's still, the general direction is down for about 2 years. And the same for silver. General direction is down, but even more than gold, is starting to show an upward trend at the end of the chart. So we'll see where that goes. When I put the two as a ratio, making silver the numerator and gold the denominator, this means that if it goes up, it favors silver, and if it goes down, it favors gold relative to each other. And you can see at the very end, I put a black arrow there to show you the relative strength of silver to gold during the last couple of months. I put the volatility chart, the volatility index called the VIX, V-I-X, and put my black line on there showing 24 is an arbitrary number, that if it's above that line, I believe that risk, there's definitely still risk in the market. As it drops below the black line, that shows a diminishing of risk. Go over to Asbury Research. They do the Asbury 6. They measure 6 technical indicators. 5 of those are positive and 1 is negative. So it's been lately, in the last few weeks, has been mostly positive. But again, we've got 1 negative at this point. Next, I want to show you the slide from Asbury Research, the cross-asset relative performance, comparing one index or one asset to another. The high beta, high volatility, to low volatility. Low volatility is more in favor. High beta would relate typically to more growth stocks, and we've seen earlier that growth stocks are definitely out of favor. Large cap to small cap is in favor based on the previous chart that I showed you on small cap versus the S&P. And the Dow versus the S&P 500, the Dow is in favor. The Dow tends to be a value, more of a value index, and the S&P is a mixed, both value and growth. So when you compare, and we've seen that value's clearly been in favor for much of the past year. So you can see here value, meaning Dow Industrials, are more in favor than the S&P 500. Then when the S&P 500 is compared to the NASDAQ, no surprise based on what I showed you, the S&P 500 is clearly losing less than the NASDAQ 100. And growth or value stocks, value is in favor, again, based on previous charts. Now, U.S. or developed markets. The developed markets for the last week, the last month, the last quarter, mostly Europe and Japan, are more in favor than the U.S. And then in bonds, short-term or long-term, clearly short-term is in favor. Now we compare, still from Asbury Research, we compare the U.S. represented by SPY, the S&P 500, to a similar index represented for an ETF for each of the countries. And so you can see some 20 countries and some regions of the world and how that compares to the U.S. represented by SPY. So it's a ratio. Which one is more in favor? If it's enough in favor, it gets a green box. If it's not, it's a white box. Do you see the U.S. in any of the green boxes? In any of the time periods? None. Look at those countries. Every one of them have equity indexes outperforming the U.S. the last week, the last month, the last quarter. Gold and silver. The gold price for the end of last week was $16.49 per ounce. That's up 2.2% from the previous week. And silver has crossed over the $20 mark again, and as $20.88, that's an increase of 8.3% for the week from the previous Friday. Facebook has lost a lot of value. This article that came from the Wall Street Journal caught my eye. There has to be a better way to lose $800 billion. So the company is worth over $1 trillion, or was worth over $1 trillion. It's now lost $800 billion of its value. Mr. Zuckerberg has lost $100 billion, and he's still left with a mere $38 billion. The subtitle on this article was, "Intelligent failures in business are based on small bets." That's generally the way it goes. Meta, Facebook, bet the whole company on their strategy, and they lost. And it's in free fall, hence the picture. This was literally the picture portrayed in the Wall Street Journal. It's in free fall. Even though it lost 73% of its value, buyers are still not coming into the market to buy Facebook. I read an article by Jim Cramer, and he was touting it in June. Of course, he usually is wrong. And he said recently, I was wrong. I'm done. I'm done with Facebook. Because he said the problem with Facebook, from Cramer's perspective, is management. He says it is a very poorly run company. Now, Mr. Zuckerberg is 38 years old. And to run a $1 trillion company as a 38-year-old, if it were me, I would want to surround myself with people who were older than I was and more experienced, and I would want to listen to them, because that is a lot of responsibility. I don't know if he did or didn't. I know as I was growing my company in Seattle, nothing like Facebook, of course, but as I was doing that, I had never been down that road before. And so we were on a fast growth track, And I definitely sought out the counsel of people older and wiser and more experienced than I was. And so we will see what happens, but it's not a very pretty picture for Facebook at this point. Thank you for watching. If you have questions or comments, leave them in the comments section below. Thank you again.